Hello. In this investor overview, we look at the events that will shape the near future. But to get the picture, let's run through the processes that underpin them all. In the wake of the downturn caused by the coronavirus, many countries have introduced stimulus measures. A key step was to start printing money and, if there was still room to do so, to lower the base rate of the central bank. Among these countries were the United States and China, which account for a significant part of the world economy. In this way, large amounts of money were injected into the economy, either almost interest-free or completely free. And you don't need to be much of an economics guru to see that this step will have consequences. And that consequence has appeared. What money could not be spent, it has sought and found a place for itself, in many cases in equities. Once the quarantine was lifted, inflation started to take off as the buying started. This was good for the US, which was suffering from deflationary problems, but now they think it is a bit much. That is why the Fed's announced that it could raise interest rates as much as 3 times this year. This in itself is probably very welcome, so the question is what it has to do with you as an investor. Let's take a look at what's expected this year. Share prices have been sky high for a reason. The bond market is much larger than stock exchange, but given the twin factors of high inflation and low base rates, investors are not getting enough for their money to at least hold its value, so the capital invested here is looking its way elsewhere. Currently there are 2 events in equities that you can observe on your own. One is the continuation of the rearranging that has already begun. Shares, previously known as quarantine shares, have already started to be replaced by shares in companies offering products and services that can be used in the offline world. The market is pricing in the expected end of the COVID. The other important thing is the fall in the stock market. In 2021, the stock market has seen a rise that has not been seen for a long time, thanks to an inflow of new capital and an otherwise low-yield environment. But this trend looks set to reverse. The news of the Fed's interest rate hike and its basically tighter communication has not only stalled growth, but also led to a major downturn at the beginning of the year. And although we are only looking at the US indexes, this will have an impact on the global economy as a whole. Of course, it is impossible to tell from the events of a single month whether this is a correction, a trend reversal, or a harbinger of a major crisis. What could play a role in this is the interest rate rise that has already been mentioned. This has 2 effects. On the one hand, from the bond market. Previously, bonds underperformed inflation, which is why some of the money from here ended up in equities. Now that the real interest rate may be positive again, this capital is flowing back from equities into bonds. And the falling demand will also reduce the price of equities. The other reason will be from the direction of borrowing rates. Higher central bank interest rates mean higher lending rates. This is true on both the retail and corporate side. This will make it either harder or more expensive for firms to get credit, or harder and more expensive for them to get finance. Whatever the case, they are faced with the fact that improvements in production expansion are not necessarily being made now. There are high-value products that people have bought primarily on credit. As harder to get credit on the retail side, this means a harder to sell product in the lives of companies. Both branches will result in them being less profitable, and this will also affect the exchange rate. Let's move on from equities to bonds. Previously, bonds were recommended for moderate risk and short to medium term for decades. This textbook form was overwritten by COVID. After inflation caused investors to earn negative real returns on them, much of the money held in this instrument moved elsewhere, partly into equities. The Fed's interest rate hike should change this and perhaps restore order. Newly issued bonds are now quoted at a higher interest rate, and those already on the market are priced at that higher rate. As you can see, this process has already started, with US 10-year government note bond yields rising since the beginning of the year. And that's just the beginning of the process. If you look at the picture, you can see that looking back 5 years, there is definitely still room to rise. One of the consequences of this could be not just a curbing of inflation, but a recovery in the bond market. Indeed, once investors get a return above inflation, they can bring their money back here. So the question is, where can you invest? Of course, in an environment where prices are high globally, you can draw from a much narrower range than at the beginning of a bull market. Which area is right for you obviously depends on many things. From the time horizon available to you, to your own risk tolerance, to your own preferences, practically everything can intervene. So here and now, we'll just look at what you should consider. If you are looking to invest for the long term, it is true especially for equities, it is the investment strategy that can be decisive for you over a time horizon of more than 10 years. After that time, the current high share price will no longer be considered high. Similar to when you look back at any time, you can find peaks and troughs in share prices, after which the economy continued to grow. For other investment classes, market cycles and potential maintenance costs are different and distort this picture. In the short to medium term, the individual characteristics between the papers of different companies will become more pronounced, so that papers that are better adapted to the current high inflation environment will tend to come to the fore. Staying with equities, there are typically two directions to go in a high inflation environment. One direction is if the capacity of the company is not fully utilized and there is demand for its products. Demand, I might add, that cannot be met elsewhere. These are firms that can raise prices with no consequences. By doing so, they not only track inflation, but they remain stable, can grow, and even pay higher dividends. But how can a company do this? Logically, people would look elsewhere for a similar product in response to a price increase. This has already been discussed in the video on the questions before buying shares. Specifically, whether the company has a stable, sustainable competitive advantage. If they have a well-established brand that you and other consumers can use to explain why you choose it, then their livelihood is secure. Otherwise, it is a fact that most consumers will look for other so-called substitute products. An example of a well-constructed brand might be Apple or Coca-Cola. The other case is when you can increase your capacity and therefore your revenues without major capital investment. These are typically technology companies. It is easy to see that Google can increase the number of units of its service far more easily than a car company. But what is happening in technology companies is that many of them performed well during the quarantine period and are now experiencing a downturn. There may still be some that are good buys, but be prepared to consider the combined effect of two effects. The question is, can we expect a crisis? The very short answer is that sooner or later it will be. But whether it will happen this year, I don't know. And not just me, but no one without a magic ball. It is not yet clear from the aforementioned stock market reshuffle whether this is the start of a crisis or just business as usual. What you can watch, for example, is oil. The price of oil is not only important for fuel, it is needed in many places. Apart from transport, it has a wide range of uses from heating to plastics production. Since there has been no lasting success in reaching and maintaining a price of around $60, the price of crude oil is currently setting new highs. This in turn builds into the price of all products and services that have any connection with oil. In other words, the high inflationary environment remains. And this will of course have an impact on finance. The other piece of news that is better than this is the price of gold. People use gold for security. Its price typically rises when people are not confident in stocks or the economy as a whole. But at the moment it's just sideways, there's no real demand for it. This increased demand would also occur if we assume that a part of the market would choose digital gold, so a cryptocurrency. This sideways shift suggests that market participants are confident of a recovery and do not currently expect another crisis.